Hello there. You're listening to Linda Pinizzotto of the Condo Expert. And you know what? You don't want your mortgage anymore. I know you don't. Nobody does. But you do want your property. But how on earth would you get rid of your mortgage aside from wait for 25 years and get that done? There's got to be other solutions. With solutions, you can get answers, but you can't get those without listening to the professionals. So today we have Konrad Kopacz, who's investment advisor with Chippingham. And Konrad, okay, so give us the lowdown. What can your company do? How can they help people move forward to start paying down their mortgages?
What we do is we look at your mortgage and see how it's situated. One thing that is very important is a lot of mortgages have prepayment privileges. So they have, you can only add 10%, 15%, or 20% on top of your regular payments or more on your principal. So what we do is we try and use a financial institution that allows us to pay it off much quicker. And what we do is we take your mortgage and we take it to the financial institution. And what they look at is they'll do an assessment on your home. And they'll use 80% of the loan to value of the equity in your home. So whatever your house is worth, times 80% minus the mortgage or other debts of your home. And they'll allow you to borrow that amount on a home equity line of credit. Preferably what the typical rate is about 3.5, so prime plus 0.5. What people do with that amount is sometimes they do renovations, do their $60,000 kitchen, which doesn't really give them that much unless they're planning to sell the house, vacations, or they use that money for rental properties, put a down payment on a rental property. Putting down on a rental property is probably the best scenario out of all the three that I mentioned. Another option is taking that amount and going to TD Bank. We use TD Bank because they have this amazing 3-for-1 investment lending program. So for every dollar you give them, they're going to give you $3. What we do, imagine you had $100,000 on your home equity line of credit. That $100,000, if you took it to TD Bank, they would give you $300,000 at a secured rate for a total of $400,000. That $400,000 would then generate tax-efficient cash flow because we invest in something called a T-Series mutual fund. The only reason we use mutual funds is because they can structure the income in a tax-efficient way. So that would cover the cost of the loan, and the difference is put towards a mortgage. So let's compare a rental property versus this. A rental property I would consider as a tax-neutral strategy because you're getting income from the tenant, and hopefully you have deductions that can cancel off any taxes that you would pay from the income that you're getting from the tenant. In this circumstance, you're actually getting a tax deduction on the investment loan, which is tax deductible at your marginal tax rate. But the income that you're receiving is actually tax deferred, so it's tax efficient in the year that you receive it. That allows us to pay for the cost of the loan, and then the extra amount goes towards paying off your mortgage.
Okay, so we're going to break this down a bit so we don't...
Right.
Okay, so what I'm looking at is basically what you're suggesting is you're pulling equity out of your property in order to reinvest it in another mechanism, which would be this mutual fund that you're talking about. And that would be through TD, most likely, because they have the 3-to-1 ratio. So what you're hoping to do then is that while you're covering the payments on your mortgages, the additional monies that you're earning from the additional investment that you have will over excel in comparison to where your equity in your property would be. So you're actually you're still bringing down your mortgages because you're paying your monthly payments. Mm-hmm. Your rate is very low. However, in the other kind of investment structure that you have, most likely your portfolio is receiving a higher rate of interest. What would an average interest rate be?
So the distribution is set at 8%.
Okay.
So what it invests in is low to medium risk securities like TD, RBC, Enbridge, Walmart. Large companies that pay dividends, that have the tendency of increasing their dividends over time, and have growth potential of 4 to 5%. So the average dividend in Canada, I would say for a large set company, is anywhere from 4 to 5%, usually the low fours right now. So you're looking about 4 to 5% growth year over year in order to make sure that you get that it replenishes the 8% that you are receiving.
So since it's a mutual fund, though, what is your locked-in period of time? So once you've pulled the equity out of your financing, so you're restructuring your mortgage and pulling money out of your investment to some degree, because you have to leave 20% in.
That's right.
In order for the bank to still consider it a conventional mortgage.
That's right.
Okay, so just for the public, conventional mortgages means basically that you have to have a minimum of 20% equity in your home. If you have less than that, then of course you're going to be a high ratio and you'd be Canada Mortgage insured, which wouldn't follow under these kind of, it would be a lot tougher. You're better to stay conventional, then you don't have insurance fees and so on.
We wouldn't be able to
You
do
wouldn't
this.
be. No, I wouldn't think so, because then CMHC would have their guidelines. So
That's right.
leaving 20% in your home, having an 8% ratio on your mortgage, pulling your equity out, putting it towards into the mutual funds that could derive you between 5 and 8% interest rates. How would you be able to then pull that money out? What time frame is there, like a 1 year, a 2 year, 3 years on the mutual funds in order for you to pull equity back out to take advantage of maybe a prepayment privilege on your mortgage to start to bring that down, or you don't really want to?
Okay.
You want to just stay with mutual funds and get a higher rate and let the mortgage do its own thing.
Okay. So the rate is set at 8%.
Okay.
So it's set like that throughout time. It is set on the value of the assets on December 31st of every year. So what we do is we actually set up your mortgage in a revolving or readvanceable mortgage. So the line of credit goes up dollar for as much money that you put down on your mortgage. So like BMO has the BMO Ready line, Scotia has a total equity plan. If you put down $25,000 down to your principal in year one, $25,000 becomes available on your line of credit up to 80% of the value of the home. So what we do is you don't necessarily want to sell a mutual fund, because it's an asset that's generating you that extra cash flow. The whole point is to, if you're already making a monthly mortgage payment of, say, like $1,500, this is supposed to add towards what you're doing already. So if you're, in this example, if you're taking out $100,000 from your home equity, doing this 3-for-1, and investing in a mutual fund that pays 8% set, and it's a distribution. It's not an interest or dividends. It's a distribution, a tax-efficient distribution. That would roughly get you about $1,500 extra cash flow as well. So you would take that $1,500 plus the $1,500, and your new mortgage payment would be $3,000 in that example. So what your hope is that you're putting it towards the mortgage, the primary residence, because it's not tax deductible. You're getting tax deductions on the investment loan, and your equity in your home is now building quicker compared to how it was before when you were making only $1,500 payments.
Right. So your tax deductions then would make the difference at this time of the year when you then file your income tax.
That's right. So on a
Right.
$400,000 investment loan, that's including your home equity line, if it was at prime and a half, you're looking at approximately $14,000 in tax deductions against your marginal tax rate.
Right. So, well, they say that just on an average, I know when they're selling RSPs, they talk about if you put in 20,000, chances are you get 10,000 back, depending, of course, of what your tax bracket is going to be. But I guess it would be easy to surmise that it would probably be roughly around that 50% ratio.
Not necessarily 50%.
It depends on where your income is.
Exactly,
of course.
but it works exactly like the
Right.
RSP when it comes to deduction purposes.
Right.
So you're
right.
absolutely right when you start making that comparison.
So now, is there anything with, I know a lot of people want to have accounts, different funds for children. Is there any type of strategies that would gear towards that type of thing? So people are quite comfortable to pay down their mortgages, but what they want to do is they want to get involved in something that would actually set their children up a little bit easier, either for their education or maybe, once they get older, or whether or not it's like to have the availability of funds for down payments on their first property or that type of thing.
Well, funny enough, The RESP, which is the Registered Education Savings Plan that the government set up to for your children's education, meaning that you could put up to $2,500, and they'll match you 20% as a contribution from the government for that. And you could also over-contribute up to 1 year of past contributions that you might have not done. It's good for as long till like age 17. So say if you didn't do any contributions till age 10, you could go to age 10 and put another $2,500 for age 9. And then the next year you could contribute again twice to catch up on the years that you've missed.
Oh, so you can actually do that, can you? You can do the same thing in the RSP as well.
Yeah.
You can, yeah.
Unused
yeah.
RSP room.
Yeah, exactly.
But the RESP is, funny enough, is when people use this strategy we were talking about, we tell them temporarily, depending on the child's age, temporarily stop your RESP contribution. Put it towards the mortgage. And this is the reasoning why. When you're getting the tax refund from the investment, so as you're getting that tax deduction, now you're getting a refund for it.
Right.
Use that refund to put it into your RESPs and now get the government grant of 20% from the government. So you're using government money to get a government grant instead of having to put your money down.
You know what amazes me? It really does is that, Konrad, there's so many different unique ways that you can work with your investments and your monies, but it's not always out there. Like it's not like you can open up the Toronto Star and read an article and all of a sudden learn this information. And that's why people need to have good investment advisors so that they could find out the different opportunities and in particular grants. Mm-hmm. No idea that there was grants out there for that. You're listening to Linda Pinizzotto here at the Condo Expert. I'm speaking with Konrad Kopacz. He's an investment advisor with Chippingham Financial Group. And if you have questions, you can actually email Konrad. And actually, you give out the email here, Konrad.
Sure. So it's KKOP as in Peter, ACZ at chippingham.com.
Excellent. So you're listening to Linda Pinizzotto. We'll be right back.